as you guys have been watching, probably the markets have been sometimes without logic, and I'm sure Mike will give us some more clarity on where we're at today. And with that, I will turn it over to Mike. And just to let you know, I'm Debbie Dabrowski with the Vermont Community Foundation. I'm the CFO. And so with that, I'm going to turn it over to Mike and let him give us some insights. Mike.
Great. Thanks, Debbie. I appreciate it. And it is nice to see many of your faces and hear your voices. It's fantastic. You can see, actually, I was there's a couple of things that are making me unhappy right now. One is the investment returns we had in the first quarter. We'll come back to that, of course, in a minute. The second is the fact that if you looked at, I was looking at all the cool backgrounds some of you had, and you look at my background, I'm a financial advisor, which means I'm now in the basement of my house. That's the only place I'm allowed to be. So I think pretty soon I'm gonna have to sleep down here too. But so sorry for the really awful background that you're looking at. So let's start off right at the very first point I made a minute ago, which is for those of you in the long-term pool, you saw a 19% decline for the quarter. It was literally, we've been working for the foundation now since 2002. So that's 18 years just about. And we have never had a quarter like this. We've had down quarters. We've had double-digit losses, and I'll talk about that in a minute. But we've never had a quarter that was this difficult in terms of the performance and the relative performance. And it leads to a lot of questions that you have that I'm sure you're thinking of. And I just hear somebody's background noise, although I'm not sure if that is. It leads to a lot of questions. And we're going to do our best to answer them. And I want to start off with just a few things that we didn't do and things we did do. So what were the things that we didn't do that led to this result? So the first thing is what we did not do was come into the year and say, you know what? We think the U.S. economy is going to be great this year. We think U.S. corporate profits are going to be good this year. We think about all kinds of short-term events. And that leads us to say, let's own a lot of risky assets because that's the way you capitalize on a good economy. We did not do that. And for those of you who have been on these calls before, you'll know that we never do that. We're not believers in any kind of short-term forecasting whatsoever. And the reason is this sad, horrifying event we've had is perfect reason for it is that things happen and bad things happen and good things sometimes happen too. And those things are surprises. And when they happen, there's no time to react to them. It's just very quick. So the surprise factor has always been a very big governor of what we do. On the other side of the equation, so what do you do eventually, and how did you lose 19% in the first quarter? The things we definitely do is take the long view. We also do something which proved to be very detrimental to the portfolio short term, but not long term, which is we emphasize investments where we think we are getting a bargain. We do not like to pay for perfection. We do not like to pay for what everybody knows and thinks already because there's a lot of risk in overpaying for assets. And we're going to talk a little more about that later. So what we did is we had actually did have though a lot of equities, but we didn't have them because we had a short-term view of the economy. We had them because we have some incredible bargains, which leads to the second point, the third point, I'm not sure how many points I'm up to, which is, let me tell you something else we didn't do. We didn't invest in a whole bunch of bankrupt businesses or businesses that are about to be bankrupt. The pandemic has not done any material long-term damage to the portfolios companies we do own. But the market, of course, has taken a very dim view of some of them more than others. And the portfolios, my big point here is that it has no permanent impairment. It has just higher expected returns now. And that's why when you go back through time and you look at market downdrafts, the two things that impede your progress in terms of recovery is one, having had bad investments in the first place, i.e. bad companies or companies you overpaid for. Those mistakes time doesn't help you with those mistakes. And the other thing people do, which we're not doing either, is they get nervous and they make changes to their portfolio at ill-opportune times. We have not done that either. I'm sure everyone on this call would have been shocked if I said that we were making all kinds of big changes to the portfolio. That's not how we've managed this, and the foundation's managed this over 18 years. So with all that aside, so my point being, the big message being that it was a very rough quarter. We think it's actually, the pandemic's not temporary, the health issues are not temporary, the economic catastrophe going on right now is not temporary. We're not making any short-term predictions, but I think we can all agree that things don't just get better overnight in times like this. But as you're seeing with markets, and we'll get back to this a little later too, markets are acting in a way that some people find mystifying. I will tell you, we do not find it mystifying, only because we have no expectation of rational behavior in the short term from markets. And so once you've kind of given up on the idea that markets are going to reflect something that you can see in front of you, you don't have to worry about what they do so much in the short term. So my point of optimism will be that there is a lot of embedded recovery in the portfolio. I'm very happy we're having this call today and not 2 months ago, because we actually have some evidence to support that point, and I'll get to that in a minute. So with that said, let me start off, and I'm sharing my screen for those of you who are on video with us. And if you're on your phone alone, I'm on slide 2, and I will try to remember to point out what slide we're on. It's the slide entitled "We've Been Here Before." So these are, in this 18-year period we worked with the foundation, we've actually only had 4 double-digit downturns in the portfolio. And when you look at this, so these are the 4. One in 2002, the second one is the global financial crisis, of course. The third one is the breakup of the EU crisis, the ECB crisis. And then this is the one we're in right now, which is the 2020 crisis. So first of all, you can see if you look at the second column, this drawdown, which is the loss, this is the maximum peak to trough loss. So we have lost, as you saw, that first quarter was a 19% loss. We were basically flat in January, which is why the portfolio shows a 19% loss for just the 2 months. So that's the loss. And you can see actually it's horrifying. It's not the worst we've ever seen, but it's actually the second worst we've ever seen, with the global financial crisis being the only one that was worse. It's interesting to point out that, at least so far, it looks like the other drawdowns, in the sense that it's been short, because it's not necessarily over yet, by the way, but at least at this point in time, it's over for the moment. The third column is how do we do compared to the S&P 500? And this is one of the points of great frustration for all of us, which is that in the past, when we've had these sell-offs, the portfolio did dramatically better than the S&P 500. This time it didn't. It barely did better. In fact, right now, it's not even doing better at the moment. Well, that's changing quickly. So that's something we're focused on, but as I'll talk about later, we don't think that is actually a sign of weakness. We think that's actually a sign of the future strength of the portfolio, that it is not invested in names that are extremely popular and priced for perfection. And we will talk a little about that later. Then the fourth column, which is a really important point: time until high watermark regained. So what that means is, how long did it take to make back the loss? So you can see it's been anything as short as 5 months to 22 months. And when you look at a 35% loss during the global financial crisis, it's hard to remember now, but it took less than 2 years to make back all that return. Now keep in mind, when you lose 33% of your money, you need to make a 50% gain to get back to where you started. And when you're in the midst of a gigantic economic sell-off and catastrophe, it's very hard to imagine a diversified portfolio, making 50%. Yet that's exactly what happened, and then some. And so you can see that it did not take long to recover. We're not, the NA is there because we don't know yet. It hasn't recovered yet, the portfolio in the last line, but we don't know. And we don't know. It could be 2 years. It could be 3 more months. We have no way of knowing this. It's just an incredibly uncertain thing. But the message here is that it doesn't take forever. And I think that's an important thing, especially when you think about trying to be too clever around when things will get better, because we don't know. And we'd rather just hang in there, take our lumps if things go down again, but then be at the right place at the end, which is that last column, which is what did you make on a 5-year basis when you include these calamitous market events. So just to explain this column, what we did is we said, what was their return 5 years from the peak of the market, i.e. before the drop occurred? This is not from the bottom, because that would be too easy to make a statement about that. This is, let me pretend for a minute that I had the world's worst timing, and I put all my money in the portfolio for the very first time in May of 2002, which is when the market was about to collapse. And what that says to you is, I would have actually, even with that most perfectly awful timing, I would have made 8.3% per year on my money net of fees over that period of time. And even the global financial crisis, if you had the misfortune to literally establish a fund at the Community Foundation right at the peak in November 2007, 5 years later, you still wouldn't have been thrilled, but you might have been a little surprised along the way that you actually made 2.4% per year, by the way, over that period of time, including that catastrophe that you got, quote unquote, we all got perfectly wrong in a sense. And then you'll see 5.3%. Of course, we won't know until 2025 what the 5-year number will look like from February 2020. But the big point here, again, as I said, is these things, they have happened before, they will happen again. And the critical things are, what do we do along the way to ensure that these recovery periods are as short as they can be, and that when money comes in at exactly the wrong time into the portfolio, that it still does just fine when this story is written. And so these are the critical points here. So actually, I don't think we've established a way to do Q&A here. So I'm going to keep motoring through the slides, and we'll do the Q&A at the end. Maybe that's the best way to go. Debbie's nodding, so I'm going to take that as a yes is the way to go.
Sounds good.
Okay, so just to point out something which we thought was interesting, is that this was actually one of the most violent declines since 1950. So you have to go back to the 30s to see a decline like this one. So this crazy graph we have, which is a little hard to read, I admit, but what it's showing you is every single line, and you can see the legend at the top, reflects a different market decline over time. The green line, for example, is the 2000 decline. I think that's a bluish line. The one that's, you know, kind of the middle of the page, I don't have a pointer, is the 2007, 2008 thing. We were just talking about the global financial crisis. The red line to the left is the current crisis. Now, this was as of March 17th, so that we all know the markets have rebounded quite a bit since here, but this is still where it was around the bottom, basically. And with the way you read this graph is the first thing is, how deep was the decline? So that's how far down the line goes. And you can see that this decline wasn't particularly notable from that perspective. We've had much, much worse in terms of, especially the gray line, the blue line, the green line. Those dropped a lot more than this decline showed. But when you go to basically the horizontal scale, when it's further to the left, like that red line is, that's not because it's more recent. That's because it happened faster. It only took about 20 days or so for this to happen. Whereas these big giant declines, for example, the blue line in the middle, that took basically a year to happen. And so it's just been much more violent, much more, the speed with which this occurred was just stunning. And I think was actually part of the reason the portfolio did as badly as it did is that this is a pure, and we haven't seen a panic like this in a long time. In fact, you could argue that 1987 was in fact the closest thing to it, which is the line right next to the red in terms of how quickly the carnage occurred. So this is a significant part about the psychology of what markets have been doing. So if we turn to the next slide, here are the results. So we were quick to want to show you May results, so we added those on. So you did see, and I referred earlier to the 19% loss for the quarter. So that's still in the numbers, of course, but you can see at the end of May, it's actually the portfolio, the long-term pool is down 9.2%. I can tell you that through yesterday, the portfolio is actually now down about 6% year to date. So it's continuing to make its way back. It's closing that benchmark gap too. So the benchmark gap is something we'll talk about along the way here. We actually think that in part it's because we own a lot of equities. In part, we didn't have as much in really defensive assets as you really needed to have in this time period. But that's the fuel we think that gives the portfolio its long-term success. As you look across the page, so the first line is the long-term pool's net returns, net of investment manager fees. So the calendar year to date is, again, one of the most awful returns I've ever showed any of you on these calls. In 18 years, I guess we were due for one. I'm sorry to say it happened. But and we're focused on how to recover. And what happens, and I'll show you a graph in a minute, when you have a terrible endpoint, it skews your longer term returns, because when you look at this chart, you say, you've underperformed for the year, you've underperformed for 3 years, underperformed for 5 years. It's been a long time since you did a decent job for us. And so we're going to come back to that in a minute and talk about why that's not exactly the right way to interpret that. 7 years, 10 years, 15 years, and since we started, the returns remain above the benchmarks. We're not thrilled about 7 years being only 0.1% ahead, but I guess we're glad to be hanging on for dear life, for at least for the 7-year period. The SR pool, a socially responsible pool, is right underneath it. And you can see it actually did better. It did better in part because it has more bonds in the portfolio. That was quite helpful and quite defensive. It also has a little bit more exposure to some of the growthier parts of the economy. So that's also been quite helpful for it. And the pool has done very well, as you can see. It's actually backwards from the main pool, the long-term pool, in the sense that it's underperformed for 10 years. But it's outperformed for some of the more recent periods, 5 years and 7 years. So it's an excellent pool. We'd like to think we're only offering excellent pools. They are very different strategies. And so you will see that one will do well and another one's not. And we're not doing that for any real purpose other than the fact that the opportunity sets are different when you look at socially responsible investing versus this broader universe of investing. And then the midterm pool is largely an index fund. So it tracks the index more carefully and more clearly. And so that's why those returns tend to overlap to a larger degree with the benchmark. We're not looking to outperform by any margin whatsoever. We're just looking to stay kind of where we are, maybe a little higher. So moving on, this is what I wanted to show you, which is these are the long-term pool's return. Oh, I think we have a typo there. Sorry, it's not the long-term pool, it's the long-term pool. Sorry about that, guys. I just noticed that. But this is the long-term pool's returns on a rolling 3-year basis compared to the benchmark. So just a minute ago here, I showed you that the pool's up 3% per year and the benchmark's up 4.8% per year. This is that same chart. This is a different way of looking at that, which is that number I just showed you, 3 versus 4.8. That's negative 1.8%, right? 3% for the pool, 4.8 for the benchmark, you're down, you're behind by 1.8%. So if you look to the very far right-hand side of the graph, it kind of bounces up there a little bit. That very last point is negative 1.8%. So when you look at the rest of the graph, though, this goes back to where we started in 2002. It says, let's look at every single 3-year period along the way. We move it up once a month, basically. And how do we do compared to the benchmark? And you can see, I didn't count up the number of times, but this is probably, I mean, it's 18 years, so it's got to be, and I'm doing the math in my head, 250, 275 data points, 275 3-year measurement points. And you can see, other than way back in 2005, we've actually almost never underperformed on a rolling 3-year basis. And the point that happened here on the right, that's just March of this year, believe it or not, is that gigantic plunge on the right. So the point I would love people to walk away from here is like, wow, this is very unusual. They've done well. Maybe it's not the portfolio. Maybe it is some combination of the markets and the portfolio. And maybe that will reverse very quickly, which is exactly what we think is going to happen, by the way. It's an unusual occurrence. We're not suggesting for a second that it won't happen again. We're not even suggesting it can't take a little while for it to come back. But again, we think that the very same strategy that created this big gap above the benchmark for almost every rolling 3-year period, we're still doing the same things. And the market hates what we're doing right now until recently, but that doesn't mean it's wrong. And so that's a very important part of the case for largely staying the course here. Although, as I'll talk about in a minute, we're thinking about a lot of things, and you can't just ignore the world around you as an investor. That would be foolish. So last but not least, on performance, this is the ranking of the foundation compared to 2 different universes we use. FOG is basically the Fiscal and Administrative Officers Group, which is community foundations like the Vermont Community Foundation. And Investmetrics is actually a broader universe of endowments and foundations. It includes colleges and universities, includes private foundations, it includes religious organizations, basically all nonprofits. So the way you read this chart is, first of all, we're back to March. And the reason we're using March, I would love to use May because it's much better. But March is quarterly data. It only comes out every quarter. So March is our most recent data point. So the way you read this is if you're in the 4th quartile, like we are in the Investmetrics universe for 3 years and calendar year to date, that means you're the bottom 25% performance-wise. It is a place we are rarely in, but we have been in before, by the way. But that's not a good outcome, clearly. If you're in the 3rd quartile, which we are against the Community Foundation universe, as you can see for 3 years in the year-to-date period, you're below the average, but you're not in that bottom of the barrel group. 2nd quartile, which you can see for 5 years and a lot of the longer periods, we're above the median, but we're not top quartile, which is 1st. And so 1st quartile, where we sit very comfortably for 15 years, 10 years against community foundations, and actually since 2002 against the Investmetrics universe, is like, that's the place you want to be, of course. And that's where we try to be over all the longer periods of time. The shorter ones we're not quite as concerned with. The interesting thing I just want to point out, and the reason we showed you this way, I was fascinated, frankly, and shocked that negative 19% didn't put us in the bottom quartile of everything under the sun. But I guess there was a lot of pain out there, more than I guess we appreciate. We're not really focused on what others are doing. But what I will say is that the Investmetrics universe is a complicated universe today because I mentioned earlier, there's a lot of endowments and foundations outside of community foundations in it. Especially the large ones are huge owners of private assets. And one thing I can tell you, even in the community foundation portfolio, our private asset portfolio will actually hold up pretty well here in the quarter so far. But there were no valuations in the numbers. And so the returns are actually a little bit weaker than the ones we're showing you. But my bigger point here is that the Investmetrics database is even weaker than their numbers are showing. Because if you have 7% of your portfolio in things where there's no valuation for March, that's one thing. If you have 30% in them, that's a much bigger issue. So this universe is very much overstating our return. So we're not really sure we're actually in the 4th quartile, but we're definitely not in the 1st or 2nd, just to be clear. So we're not changing that point in any way, shape, or form. So if we turn on to the next page, let's shift to what's going on, what are the markets doing, and what are we doing? I mean, these are the things that I'm sure you're mostly concerned about. We can't erase the losses of this year. They happened. And now how are we going to get that money back is the question. So the first thing is to sit down and say, what is going on here and what are the implications of it? So the first thing is this bullet point at the top, which is the risk in the markets and the risk to businesses, at least. We'll talk about the risks to the rest of our society in a minute, but the risk to all these entities is that nobody really knows. I mean, we really don't know how the economy restarts. We don't know even what that looks like. If there was a vaccine or a cure tomorrow, that would be a different scenario than the one where there's never a vaccine or a cure, and that we have to live with this for years. There's a lot of uncertainty, and markets are naturally going to be very, very volatile at times of uncertainty because it's just impossible to know. One of the things I started with was this, to me, kind of cute little story. We all told ourselves that the economy was in great shape and everything was good because that's a forecast. But it felt like a safe forecast. Now, nobody wants to make a forecast because people understand, of course, that it's impossible to make a forecast right now. Who knows what's going to happen? So the second point, though, which we do think affected the portfolio in a big way, is that there's a lot of weird stuff that has been going on in the markets and will continue to go in the markets. There's a lot of computer-driven investing today. There's a lot of passive management. Passive management, by the way, is not the cause of market problems. Passive management is a good thing for the markets. However, when you have more dollars in passive management, you have less dollars trying to pick the winners and losers. And that leads to the third point, which is there are fewer fundamental investors, or at least less fundamental dollars. So this combination of the computers, which are largely momentum driven and just chase what's working to some degree. I'm oversimplifying their strategies. Apologies to those of you who love quantitative investing. And then the fundamental investors, which create a counterbalance, so to speak, that scale has been tilted very much towards the momentum side of the equation. And that creates instability in the markets. It doesn't create permanent problems for us as investors, but it creates more potential short-term problems for us. And that's, I think, part of what we saw in this first quarter. And then the last thing is that, other market declines like 2011, you can say, yeah, this is going to be fine. And we know it's going to be fine. And I think we all hopefully are optimistic enough to believe that this time we will repair ourselves and we will get better. But this is an incredibly stressful time. Literally everything, Debbie did a great job talking about the upside of this, but you have to think long and hard about the upside of this. And that's the problem, where our lives have all been upended. And the idea that that doesn't have any impact on anybody is insane, of course. So that creates even more fuel to this fire. So what has the foundation been doing? The first thing the foundation has been doing is the team led by Debbie and I have been in touch. We love each other, but even more than normal with each other in terms of spending time talking, spending time making sure that the portfolio is being properly responsive to the needs of all of you on this call, others, and the community. So the first point is critical. We must have enough low-risk sources of liquidity. To be clear, we had them coming into this. That wasn't one of our issues, and we hadn't had to do a whole lot. But we've had several conversations about making sure that we don't get in a position where this is a problem. The Community Foundation has never been more important than it is today, and the portfolio needs to support all the efforts that are being undertaken. The second thing is the monitoring, which has always been rigorous. It's much more intense. I'm going to talk about that a little bit more. That's largely falls onto our plates at Colonial, but we're going to talk about that in a minute. And then the third thing is to be thoughtful and risk aware while maintaining the strategy. And what that means in English is check, double check, triple check that people are being thoughtful, the investors that are picking stocks, picking bonds in this portfolio. Avoid people who we think aren't taking the seriousness of the risks seriously enough, excuse me, forgive me the redundancy. And three, though, but stick to your strategy. The time to change things is not when things aren't working. In fact, it's the time to lean in. And we've been trying to do some of those things. I'm going to give you some examples of that in a minute. So our investment process here has always been built on several things here, and this is the current process. The first is that we are, as I mentioned earlier, we don't make short-term forecasts. But what we do is we built a diversified portfolio, and there's a reason for that, because bad things always happen at some point. And we're optimistic people by nature, but and we know, and everyone knows that there's no way that you're not going to have something bad happen along the way, and several somethings, of course, will occur. So that's why you stay diversified. The diversification didn't serve us as well in the first quarter as we would have expected, but it's starting to work now the way we would like it to. And we think that when this year is actually finally put in the books, that you might look back and say, at the end of March, this thing looked like it wasn't working, and then it worked beautifully for the whole year, including March. So it's going to be, we think that's actually very probable at this point. The second point is our responsibility to all of you and to the foundation, which is the day-to-day. So we're, as you might guess, like many people, especially in New York City, where we have no office we can go to right now. Our team's working entirely remotely, but we're working at 125%. Everybody's engaged. People canceled their vacations, unfortunately, because they couldn't go anywhere. Anyway, I'm not laughing. That's not funny. But they did. And so we've been in frequent contact with every manager, not just the foundations, but all the ones we know out there, and there are hundreds of them. And the idea is to learn what they're doing, what they're thinking, and to judge them too, because that is what we do, and ensure that we have the right people making the right decisions in this portfolio. We've spent a lot of time on appraising the exposures versus the targets. In a volatile time, you do not want to let the portfolio drift too far away from the board's adopted targets here. So we've been very consistent with the strategy. And the third thing is we spend a lot of time, talking to the managers I mentioned earlier, but we have position level data. So we don't just let people tell us what they like and what they don't like. We check, recheck, and check again. And when I told you things like the portfolio's up, in May so far, and June, I mentioned too, that's because we have daily pricing ability on this portfolio. It's not perfect, but it's close enough to be good. And then the last thing is that the base case, you have to have a theory to underlie your thinking. And that is that this is not a short-term event. And this is a theory, by the way, that we were on back in March when we were all as shocked as everyone was, I think, which is that this is not going to be a short-term, there's no problem here scenario. And we don't do that so that we can run into a bunker and not invest capital. We do that so that we can think about what are the risks to the portfolio. So on the next page, I think I just talked about this a little bit, but I just want to remind you what I just said. So frequent check-ins. Frequently, we're getting on the phone with managers every 4 to 6 weeks at this point. We might slow it down a little bit now as things are calming a little bit, but those frequent check-ins have been very, very interesting and very useful. The second thing is the questions we're asking, the questions we're thinking about in our minds is, first of all, tell me how you're valuing businesses. One said, for example, a good example of that would be, I never thought to value this company with no revenue for a year or maybe 2. And that's unfortunately something that who the heck would have thought to do that for a large publicly traded company, but here we are. So what are you doing as a manager? How do you think about that? How do you assess that? How do you value a business knowing that? The third point, or the third bullet point here, are you maintaining your composure? That is, by the way, people forget, that's the obvious, but these are human beings. They're stuck in their homes too. They have stress in their lives, and are they actually keeping their long-term view? And that's why one of the things that's important about our process is we've always spent a lot of time with people. We used to be on the road traveling like crazy to go see them, spend time with them, get to know them as people, and really know who we're dealing with, because that's a critical part of this process. We can't do that part right now, but we can talk to them. And when you have a history of spending time with people, you can assess them much more rigorously than if you just for the first time started paying attention to them as people. So this is something we've been very, very focused on. I am glad to say that there was one manager in the portfolio that we thought was having a hiccup. They are not right now, so we're feeling better about that. But of all the other managers in the portfolio, that was a very small exposure, by the way. But of all the other managers in the portfolio, everyone has been really, really great. So we're really excited. And then the last thing is the wish list. We have always had a wish list of 8 to 10 managers that we would love to have clients invest with, and they're just not accepting capital. Some of the great investors out there, actually, which no one really knows their names in the larger world, are very careful about how much money they manage, and they're very much not taking in money almost all the time. Well, that does change at times of crises, and that's how we make ourselves feel better, which is that we can do really interesting things and smart things that 5 to 10 years from now look really, really good because they cannot be done then. And the portfolio, by the way, right now is filled with ideas that came out of the 08-09 time frame. I actually really hope we don't get these opportunities here, because that means we're in for another year or two of really ugly and hard returns, and nobody wants that. But if we have to have that because we can't control that, we're going to do things that 5 to 10 years from now are going to really pay huge dividends, and that's the wish list. So one more page or two here. I'm going to jump by this page, except for to say one thing. What we're looking at here, and I think this gets into what's going on in the markets right now, which I think is a really important point. A lot of people are mystified, as I mentioned earlier, by how can, I think we just saw there's 42 million Americans out of work right now, and that's not getting better anytime soon. I think we can all, unfortunately, agree on that point. Yet the market is acting like nothing ever happened, and people have a hard time understanding that. And by the way, there's 2 important concepts to think about here. One is, first of all, the markets don't necessarily reflect the facts in front of our faces. That's the first point. They're supposed to look forward. I don't really give them that much credit. I just think they react to whatever they react to. And I mentioned earlier, computers are very much a part of what's happening in the markets today. The second thing is that the markets have convinced themselves that there are clear winners and clear losers. And like markets do, they've made it binary. If you're Zoom, like we're all on this call today, you're a winner. If you're Amazon, you're a winner. I'm going to a whole long list of companies that are supposedly winners. Then you get to a whole bunch of business, like let's say a European industrial company, a real estate company. You can have a whole long list of things that, well, you're the losers. And there's a truth in that, right? There is, yeah. I mean, Amazon, Zoom, these businesses are thriving right now. And there's arguments that can easily and probably correctly be made that they're going to have better businesses than they would have, for years because of what's happened more recently. All true. The problem, though, is that I mentioned earlier, Zoom is trading at 60 times revenues right now. Another fun fact for you, the NASDAQ composite, which has Apple and Amazon and Facebook, and a lot of these names in it, is now worth more than all the world stocks outside of the United States combined. That's just wrong. There's no way, the economic output of 10 large US tech companies is actually not greater than the entire rest of the world's economic output. So the point is that markets get way off the rails. And that's where, when I think you ask, well, why are markets going up? The answer is, well, the Fed is here. There's a whole bunch of things that are letting people feel like, well, maybe it's going to be okay. They like watching markets go up. People want to get in on that. So the fear of missing out kicks in. But what is the problem that's emerging is that we're taking businesses that are perceived to be the winners and grossly overvaluing them. It's not that they're bad businesses, but when you pay too much for something, you never do well in the long term. And on the other hand, this is why we're so excited about this portfolio, when you own the losers, or even just the neutrals, the ones that no one's quite so sure about, they're so cheap right now that we mentioned here before that some of these companies have dropped to levels that are basically, 70, 80% discounts to what they should be worth. That's a massive amount of future return. And we're starting to see that in the portfolio. I'll give you just a quick example. We have a small manager in the portfolio who, has been one of our more controversial managers, a very young portfolio manager. But what he did in March is he took, basically, he's a very small position, he's very concentrated. He took 20% of his portfolio and put it into a UK online fashion company named ASOS, which you may or may not have heard of. I know my daughters buy stuff from them sometimes. He did that because his point was that they were raising new capital to make sure their business was in good shape from a balance sheet perspective. And they had a really, really great operational ability and potentially huge market opportunity because of the whole online, enhancement of online shopping at this point. So the reason I bring that up is he put 20% of his fund in that. That stock is now up 250% from March 17th through now. And that's an example, by the way, of a stock that had been beaten into the pulp, beaten down because it was a boring business. Amazon was going to kill it. Everything was going to go wrong for them. And my point is that people change their views very quickly. Things aren't always what they appear to be. And the foundation, by the way, and the point I'm making is, forget about online for a second. Industrial businesses, financial services businesses, cyclical businesses, all kinds of European businesses, Asian businesses, blah, 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 I can go on and on. These stocks are trading at levels that they should be double or triple the current price, just that the world is barely okay. Forget about it being good again. So this is where all this opportunity lies in the portfolio. And that's why at the bottom it says, thoughtfully add to investments with extraordinary upside and limited long-term risk. And the reason we can say limited long-term risk, I'll come to that in a minute. Let me go on one more tangent, sorry. On this slide, we're showing you the asset mix of the portfolio. So about 50% in stocks, as you can see, but the long-term pool also has hedge funds. And those hedge funds plus the high yield bonds basically give the portfolio a much more stock-like view than the 52% looks like. The other point you can see is that the SR pool has 30% in bonds and none of it in high yield bonds. So that's why earlier I mentioned that the pool's done better than long-term pools so far this year. And then the midterm pool is a very balanced pool, 47.5% stocks, 47.5% bonds. And of course, the Vermont investments are a critical part of the foundation strategy and are a part of all of the pools. But this is a very balanced mix. It has not been changed, just to be clear. We've tried to keep the portfolio very close to it despite all the volatility, and we've had some good success there, I think, so far. And the committee, of course, and the foundation review this at least annually. And right now, the way things sit today, I'm not sure we'll change it, but this is the mix we have for now, and there's certainly not been a discussion yet about changing it. It was a good mix before this crisis. It might be there might be things we could do to make it a little bit better now, but it's certainly a good mix to serve us through this crisis because it does have balance. So I wanted to get back to how do we, go back to this bullet point here, sorry. How do we thoughtfully add to investments with upside? So the upside part's easy, and the limited long-term risk thing is the really critical point here. That's what we want to do for you in this portfolio, is generate good, strong returns and limit the amount of long-term periods where you say, oh my God, you really didn't make any money in the portfolio. We don't like losing 19% in a quarter. But what we dislike even more than that is having a 4% return on our equity portfolio when we need to get 7 to 8% minimum from that portfolio over 7 and 10-year periods. So you have to really think about how you define risk. I really don't like having to talk, and I'm sure none of you like hearing about 19% losses. I'd feel even more upset if I had to talk about pathetic 10-year returns in this portfolio. That's the problem that we think about most. So this graph looks at something that we call value and growth investing. I will not torture you with all of the definitions here, but to put it in, I think, very straightforward terms. Value refers to the idea of buying businesses at low prices. Growth refers to buying businesses that have quick or fast growth in their future. That's the very simple equation. Now, the problem, of course, is it's not really how the world works. Value investors are happy to buy growing businesses. They're just not willing to pay a ton for them looking forward. Growth investors are a little more monolithic in the sense that they will not buy a cyclical or slow growth or no growth business. So the value investor actually universe is bigger than the growth investor universe in some degree. But the point is that these are very different ways of thinking about investing. So the first thing is, if you look at this graph, you can see on the far right-hand side of the screen here, I just want to turn this off so I can see better. This is a look at rolling 10-year returns for a growth index, the Russell 1000 growth, and a value index, the Russell 1000 value. So we're just showing you the actual return. So these indices started in 1979. And so this is through March of this year. But in 1979, the indices started. So the very first data point on the left-hand side of the scale, you'll see December of 88. That's that first 10-year period, basically. The orange line, again, is the growth index, and it returned about 14% per year over that period. That's where you can see that orange line sort of sits on the scale. The blue line is the value index, and it basically outperformed growth over that period. It returned about 17% per year. Now, watch over time what happens. So first of all, you can see as the lines go up and down, those are returns going up and down, absolute rates of return. But the thing that we're really focused on here is the gaps between the lines. So there are periods where the blue line is ahead of the orange. There are periods where the orange line is ahead of the blue. And if you look to the very far right-hand side of the screen, the orange line's been ahead of the blue for quite some time. Keep in mind that every one of those data points is a 10-year period. So that gap between blue and orange is a big issue. And the way you see the blue plunging more than the orange on the right-hand side of the page, that's another thing that is hurting this portfolio right now, is that we like to own things with better upside. So you might say, well, why wouldn't you just own growth stocks? They're more interesting, they're better, aren't they? And the answer is, yeah, they're better companies in many cases, but there's an issue around human psychology, which is the secret to the success of value investing long-term, which is that people get too excited about a good story and they get too pessimistic about a bad one. And so when you look at the bullet points on the bottom, value is outperformed actually 60% of the time. And that includes this awful period for value investors that we've been through now, really for the better part of the last 10 years, even more. The second point I want to make is the very bottom point, which is that 7% of the time on a rolling 10-year basis, growth stocks have actually lost money. And that's that disaster scenario I was referring to earlier, which is the theory, or the view, not a theory, that we cannot afford to have 60% of the capital, which we need to generate CPI plus 5 over time, producing a negative rate of return. We can't even afford to have it produce a 2 or 3% return. We need to produce a 7, 8, 9% return or more. And the issue is that the gaps, what are your outcomes look like? If you try to think about how you draw a band across these and capture most of the points, the band is narrower for the value stocks. It's within a tighter range of rolling 10-year returns. And that is the thing that we're thinking about. That's the risk. And again, back to boring versus non-boring businesses, that's not the point. The point is that people overprice the exciting stuff and they get too pessimistic about the boring stuff or the weak stuff. And that's the game we're playing, which is that overreaction is the thing. And so when people say, well, the economy is different today, the world is different, I'm like, yep, and it was different in 2002, and it was different in 2010, and it was different in 1988, and it was different in all these other periods of time. It's always changing. But what's not changing is human emotion and the way we are wired as human beings to think about investing and to do investing. Nobody wants to brag about their airline stocks right now. They'd love to brag about owning ASOS like I did earlier before. So my point is that this is the secret sauce in the long-term returns, is to take advantage of this. It's just been an unusually difficult time for this strategy right now. So these are our last points. First of all, balance and patience. This is what it's always about. And it's really hard to be patient when a strategy is not working. No one enjoys it. We are not having fun. The committee is not going to have an enjoyable conversation today, I don't think, but they're going to have a really interesting one, I'm sure. The second point is I don't think we've ever seen it look this good for patient capital. You know, some of these stocks, there are operating businesses that are not shrinking, by the way, that are trading at below book value right now. This is like, if you're a finance person, this is like Ben Graham's dream come true, is that you can actually buy businesses for less than what they're worth if you actually did liquidate them. It makes no sense for a company that's actually generating cash and has profits. So that's the thing that we're really thinking about. The third point is the big one. If you're looking at your own portfolios, some of your winners maybe should be winners. You bought the right things at the right time and they're still very attractive. But if you own stuff that's just run through the moon here, I would just have a skeptical eye about whether or not maybe you've gotten all the rewards for the next 10 years paid to you today, in which case you don't want your money sitting there for 10 years necessarily. So ignoring price, which is what most people do, could be a disaster for the next 10 years. And then last but not least, the noise. You know, we're going to have more bad economic news. We have a very complicated political climate right now. We have a very complicated geopolitical climate. We have trillions of dollars of new debt. We have all kinds of things to think about and worry about, and we don't know what's going to happen, back to where we started. But what we do know is that if we buy things with a margin of safety, if we buy things that are not priced for only good news, we have protection, not for the short-term returns. You just saw how that didn't work in the first quarter, but we have 5 to 10 year protection about getting paid to own and take the risk of stocks. And so that's what this whole strategy is about. And again, up until December of 19, it was really an easy story to tell you all, because you saw, hey, this is great. You have good returns, you beat your benchmarks, you lose less money than the benchmarks in the bad times. And then all of a sudden the pandemic hit and the whole thing got turned upside down. And my final message is it got turned upside down, but this is temporary. The laws of nature, as we apply them to finance, will reemerge here. And actually the hard climates are not going to be easy, but they are not actually bad news for this portfolio on a relative basis. And we don't want the hard things to happen. Obviously, nobody does, but we want to be prepared for them. And we want to be prepared, again, back to where I started, to turn the 6% loss year to date into a 5 to 7% gain year to date. I'm not saying we're going to get to that, but we want to make back what's been lost, create and have the capital available for all the need that exists in your community and others today. It's unbelievably tragic and just overwhelming. And so we're just very happy to actually have better returns in terms of the at least absolute level of loss to talk about today. So I'll stop there. Sorry for the long-winded presentation. I hope it was of some interest. And if there are questions, I'd be more than happy to try to answer them if I can.
Mike, I think there was one question in the Q&A from Dave. What were the down draws within the individual components of the portfolio? This was on the beginning slide that you had. And then it said, additionally, what did relatively worse this time compared to past drawdowns?
Yeah, well, that's a really interesting question. Thank you, Dave. So I would say, Dave's got a second question too.
Yeah.
So I would say to Dave on the first question, so the drawdowns on that first slide, it was the first slide Dave was asking about, I believe. So largely driven by equities. If you go back historically, we had two things that helped us historically. One was that our equities tended to outperform because of their value orientation in those drawdowns. That didn't happen this time. It was the opposite, in fact. The second thing that helped us in other times is interest rates were higher at those points in time, so we had much bigger bond gains to kind of cushion the blow. Interest rates were already very low, which had two really big negative implications for us. One is we went back to the asset allocation slide for a second, which I'm doing right now because I can do that. Skip right by it. You know, we came into this with, you can see, you know, basically, you know, 13% in 14% in US bonds. That did not serve us as well as it could have if we had 30 or 35%, right? And the second thing which hurt us is when interest rates start at 2%, there's only so much of a gain you're going to get on bonds. When interest rates start at 6% and they plunge to 3%, you know, you can have a 17, 18% gain on your bond portfolio. And back in 08, we had an 8 or 9% gain. This time around, we had a 3% gain or something like that. So again, that didn't cushion the blow as well. So bonds were there to help, but they didn't help as much. And then the third thing was our hedge fund portfolio also did not act well. It lost almost as much as our equity portfolio, and it did so for two reasons. One is it's equity oriented, and we've done that because I didn't want to have even more slides, but we don't usually talk about the long-term returns being quite good from the hedge fund portfolio. We'll put that slide back next quarter. They're back on their way to being really good again. By really good, I mean 6-7% returns on a long-term basis. But what happened here is they had a lot of equities, and then they had something else which make people very uncomfortable, but we think is awesome, which is when the market started to drop, our hedge fund managers didn't act like hedge fund managers. They acted like investors. And what that means is if you owned a stock that was, you thought worth $100 a share and you bought it at 70, what a hedge fund manager does when a stock drops from 70 to 40 is they sell it. And they sell it because like, oh my God, I can't lose any money. I can't show anyone a loss ever. Even though they've already just locked in a loss, which is always a mystery to me, but they sell it at 40. And you kind of say, well, it was worth 100. Why did you want to own it at 70 and you don't want to own it at 40? It makes no sense, right? So our view and what our managers did, unfortunately, as of the end of March, is they kept buying more on the way down to 40. And that's actually smart, but it's not smart when you look at it on March 31st. It's very smart when you look at it on June 4th. And that's why that part of the portfolio is coming roaring back. So the hedge funds didn't provide the defensiveness we would, of course, love to have seen, but the hedge funds were definitely a major contributor this time down versus other times down. And I'm going to show you next time and the time after, I hope, some interesting data about what we think is the wacky behavior of a hedge fund portfolio. And the question that the investment committee is going to be wrestling with is this wacky behavior just because this is an unusual time, or is this the way this portfolio is going to behave? In which case, why do we need hedge funds? And that'll be a very interesting conversation for the committee. Because again, if it's just going to go down as much as the market and go up as much as the market, let's just own stocks. And why would we do that? So that's something we're really going to think about. And just to be clear, the hedge fund portfolio has never done what it did in the last 2 months before. And so we don't really think that 2 months is more important than 17 years, but we're going to have to see what the data shows us as time goes on. Should I do Dave's other questions? Does anyone else have a question? Dave has a second one here, I can say.
Sure, Mike, that'd be fine. Do you want me to read it or you want to read it?
Okay. Dave, you're a brilliant question. I'll read Dave's question. You don't mind. So your view is that value's time will come. Yes, that is correct. That is our view. And not because I think value is superior, but even if it's not, everything's cyclical in this world. And so the cycles will always change. So then Dave goes on to say, like a high duration investment, much of growth's value is tied to the horizon. And that's also very true. So what Dave's saying, Dave, I may interpret your question for everyone, if you don't mind. What growth investors do, and this is not wrong, by the way. We actually own growth investors. I don't want to make this sound too binary in the portfolio. We just tilt towards the value stuff. But what growth investors do, they say, listen, Amazon is going to earn this much money over the next 10 years. I'm going to discount that back by a reasonable risk rate, excuse me, and I'm going to come to a valuation for it. And that's a legitimate thing to do. And one of the things that's been the fuel for growth investing over the last few years in particular, as interest rates have stayed as low as they have, you can argue that rate that you use to discount back the future is lower, and that raises the current value, essentially. That's what growth investors do. Now, value investors, I mentioned earlier, I'm sorry, Dave, I'm on a tangent. I'm going to come back to your question, I promise. Value investors, I mentioned earlier, have no problem owning growing businesses. Right? That'd be crazy, right? Who wouldn't want to own a growing business? But what they won't do is say, I think Amazon's going to make this much money for the next 5 years. No, they say, I'm going to own a company which right now, based on what I know at this moment, is very attractively priced. I'm not going to try to predict the future with that kind of specificity or accuracy. That's the difference between value and growth. So do you look forwards or do you look backwards when you value a business? And then today's question, finally, the question he asks is, because you think that value is going to have its day, does that mean you believe there will be a concomitant, I'm going to say, I can't pronounce your words, Dave. Does that mean there's going to be a rise in interest rates? And the answer is, we don't think that's a necessary condition for this to happen. But yes, that's one of the things we like about our value orientation, which is that if interest rates rise, growth investors are going to have a very hard time because, again, you have to raise those expected returns or that risk return you're using, and that makes the value of those stocks much lower on a fundamental basis. The value stuff, on the other hand, tends to get with those, that's where that money goes, is, oh, now banks are going to make a lot of money because interest rates are higher. Oh, cyclical businesses will probably do okay because they can pass through higher costs, whole bunch of stuff. And the thing that's interesting about interest rates right now is we all know how low they are. We all know how almost everyone thinks they're going to stay low, which is an interesting contrarian data point for the contrarians out there. We all know a few other things. We know that the Fed is desperate to keep rates as low as possible, and they're buying everything in sight to make that happen. Yet we also know that trillions of dollars of new debt are being issued right now just by our government alone. And is there just an insatiable amount of demand for that much bond, that much in bond issuance? Will the Fed just buy every bond that the US government issues? Is that really a scenario that can happen? And our view is, well, it might, but I wouldn't want to bet the farm on keeping interest rates low while you're issuing trillions of dollars in new debt. Because we all know as consumers, if you went out and tried to borrow $50,000, you might get one interest rate. If you went out and tried to borrow $5 million, you probably get a much different interest rate if you can borrow $5 million at all. And so my point is that, the more bonds you issue, even if you're the U.S. government, at some point, someone's got to say, no more. We're going to demand a higher interest rate from you for that. So that does tie into one of our theories. The sad thing, by the way, for our economy will be that a glut of debt could push interest rates higher, might not. But if it happens without economic health, that could be kind of a stagflation type scenario where you have really difficult economic times and rising interest rates at the same time. That's a really unpleasant scenario for our community and our world and our country. So we're not wishing for it, but if it happens, the portfolio will actually do quite well. But it doesn't need that to happen, just to be clear. Sorry for that long answer, Dave. Good question. There's another question posted. Should I just do this too? Or, I see a hand up though. Yes.
Hi, Joy Fakis.
Hey, Joy.
I'm
Hi, Joy.
on the board of the Vermont Humanities Council. And first of all, very thorough presentation. Thank you very much. Very quickly, I know in the socially responsible pool, these issues will be addressed. And you've been focusing on COVID-19 and the impact that has had, which is just huge. And because of the more recent events, those aren't going to be reflected in your portfolios. But for your long-term pool companies, are the managers in that pool, are they taking into account risks associated with worker equity, diversity, inclusion, where we know the socially responsible managers are, that's key to their process, but these are longer term risks that can affect companies. Are your managers in the long-term pool taking these new risks or newly revealed risks into account in their process?
No, that's a great question, Joy. Thank you for that. So a couple things. So one is largely yes, but I want to be much more specific than that. So one of the things that we actually just started to do was really, as we've worked for nonprofits, our firm for, actually 40 years. So the idea of thinking about the balance between values and investing, and to your point about risks that are associated with actually having harmful behavior and, basically just terrible behavior, is something every investor should always be thinking about. But what we had never done until recently, now we're about to we really just got revved up. We got a little distracted because of everything going on recently, is we developed an internal scoring system for qualitatively reviewing every single manager. Forget the managers who tell us that they are acting in a socially responsible way. Every manager. What are you thinking about in terms of environmental risk? What do you think about in terms of social risk that your business is contributing to? What do you think about in terms of governance risk that of the portfolio companies you own? The whole ESG framework base, which I know has become a bit of a marketing term, but as your question suggests, it's not a marketing term. It's actually a very real risk framework that I would argue every responsible investor, and I don't mean the responsible way in the sense of responsibility. I mean, every investor, let me put it that way, that's a better term, should be applying. So what I want to do is I don't want to answer for you or the investment committee or any other client oh, yeah, of course they are. That's just what's your proof? So what we're doing is we've constructed this really interesting scorecard approach that we're applying internally. It's largely qualitative, I will tell you, and with the explanation about how we get to things, of course, because we've been very frustrated with some of the screening that goes on out there. It's really interesting what happens, but as you know, screening is a complicated topic in a lot of different ways. People, for example, we have in the SR pool a manager who buys businesses that actually would not screen well or score well, but she does so because they're trying to change those companies. And I think that's a fantastic strategy, right? So screening has a lot of value, but we want to apply are you the real deal announcement part to this equation. So what's it going to lead to? And I don't think it'll be next quarter. We need a little more time, but we're going to score all portfolios, all managers. And then on this slide, for example, not this slide, but a slide in the future, I'm excited to someday walk you through soon, I hope. How do we do this? What is the portfolio score? And by the way, even more interesting, to your question, how does the long-term pool score compare to the SR pool score? I mean, I think that is a really interesting question. Again, I'm hopeful that the score is going to be, they're not that much different, actually, because that's what you'd like to think is happening. Even if let's for a second, I'll stop this in a minute, but let's for a second pretend that we don't care about our society or ESG risks. I still like to think that if we have managers out there who are not even thinking about it, they shouldn't be managing money in this portfolio. And you could get to a very interesting debate about owning a business that actually scores poorly and you're not trying to change it because it's so cheap that you're going to do that. That could happen in the long-term pool to a small degree, maybe. It should never happen in the SR pool, by the way, because that's the whole point of the pool. But those are the things that we're working on, Joy. So it's a really interesting question and something we're very, very focused on, period.
Great. Thank you so much.
My pleasure. Sorry for the long-winded answers to everything.
No, it's great. Thank you so much.
You're welcome. Okay, I see some more questions. Go ahead,
Yeah.
Debbie.
Now we have two other questions, but I'm going to go with the one that came up first because we're starting to get to the close of our time here. How do you reconcile the massive unemployment numbers we're currently seeing with an 18 to 24 month return to pre-pandemic markets? Are there longer term impacts on consumer spending, credit defaults, will ripple out to the whole economy?
Oh, great question too. So yeah, I'm glad you gave me a chance to clarify that. 18 to 24 months wasn't the economy is going to go back to normal. 18 to 24 months was that there will be at a minimum health-related issues in our society, in our economy, that will do damage to economic activity and to, more importantly, to our lives. So that the 18 to 24 months was more our way of saying, you know, let's hope it's wrong, but we're not quote unquote forecasting there'll be a vaccine in February or there'll be a vaccine in November that everyone can take and we can all literally pretend this never happened. The 18 to 24 months means that. The question though is brilliant because there's no doubt, especially if it takes 18 to 24 months for anything even approaching normalcy from a health perspective to occur. But it would take years after that for the economy to heal. And so it's a very, very much longer term outlook. Again, it would be shorter if we get what we'd like. I would give you an example. The portfolio has a very deep value manager, happens to be in the hedge fund segment, who has for several years had a giant position in a name that now most of us know, which is called a name called Moderna. Moderna is a stock that's gotten a lot of attention, and one of our hedge fund managers has owned it for 2 years. In fact, we used to kind of question him about what the heck he knew about life sciences. We're kind of glad now that he owns the stock, of course. But you know, Moderna maybe they'll be successful, and this will be not 18 to 24 months before we can all feel, you know, really, really safe in our families. But that's the answer to your question. It's not 18 to 24 months before we get back to a pre-pandemic market. It's much longer than that.
Sorry, with that, we're basically down to the 10 o'clock time and we need to wrap up the call. But if you have questions that have been unanswered, and I've emailed or chatted with a few people, we will put it on the question list for addressing before the next meeting. And this is also going to be saved on our website. So if someone wants to share this presentation and the corresponding presentation by Mike, feel free to do so. And as always, make sure if you have questions, send us a information via email or give us a call and we'll get back to you as soon as possible. So enjoy the day and thank you so much for your time.
Thank you, everybody.
Bye.
Bye-bye.